In December of 1924, executives from some of the world's largest light bulb manufacturers met in Geneva, Switzerland, and did something almost nobody has ever heard of. Some of the greatest minds in the industry didn't workshop to invent a better light bulb. They actually agreed to make light bulbs worse on purpose. Before that meeting, a household bulb burned between 1,500 and 2,500 hours. Then the companies in that room, General Electric, Osram Phillips, and others, capped those new bulbs, those new and improved bulbs, to just 1,000 hours. They got together and tested each other's bulbs in a factory, and whatever factories had bulbs that lasted too long got fined. The average lifespan of a bulb went from about 1,800 hours to almost half of that. Remember this story, not because light bulbs are so important, but because that meeting put into industrial practice a principle that would eventually spread across the entire economy. The principle that a product that lasts forever is worth less to a company than a product that they can sell over and over again. They have a word for that. That's called planned obsolescence. And that's the silent, uncomfortable answer to a question most people never even think to ask. And that question is, why does the economy even have to keep growing? Not why is growth good? That is self-evident. The actual stranger question is this: why can't the economy just stay where it's at and everybody keep enjoying the same good lifestyle they've been enjoying for decades already? A company doing fine this year, doing just as fine next year, is treated as a failure. And why is that? Here's the part that should make you really uncomfortable. The United States economy grew significantly faster in the 1950s in real terms than through most of the last 15 years, despite the constant record-breaking numbers you see every day in the news. And yet the cars, furniture, and the houses built in the 50s were by all accounts higher quality, easier to repair, often designed better than a lot of the stuff that you get now. Now remember the light bulb conspiracy of the 20s. Faster growth in the 50s, slower growth now, but better quality in the 50s, worse quality now. That should be the opposite if the conspiracy with the light bulbs holds true. This would be the opposite of what you would have predicted given the light bulb conspiracy decades earlier. So let's explore why. Let's start with the numbers, because that's the part most people don't actually look at. Real GDP growth averaged about 4.2% a year through the 1950s, then about 4.5% through the 60s. That's a genuinely strong, broad-based growth decade after decade. Throughout those same decades, corporate profits sat at a strikingly modest share of the total economy. By the broad measure economists commonly use, hovering around 16% of the GDP. And that's in the 50s and 60s, a level that would almost look tame today. CEOs of major companies earned about 20 times what their typical worker made, not 200 times, just 20. And the stock market itself, measured against the size of the broader economy, what's now called the Buffett Indicator, spent these decades mostly in a 40 to 100% range relative to the GDP. The market was a reflection of the broader economy back then, not something racing ahead of it. This was the era of what economists called managerial capitalism. Companies ran with the implicit understanding that they served several masters at once. Shareholders, obviously, but not just shareholders, also the workers and the communities that the factories operated in, also the reputation of the product itself. A company built a refrigerator to last 20 years because a company that made junk got a bad name in a town where everybody knew everybody else and where the employees worked in the same factory for most of their career. Here's an uncomfortable footnote, though, the same thesis this documentary opened up on. Planned obsolescence was already at play back in the 1920s, years before the golden age of quality in the 1950s. This doesn't fit the narrative. The fact is, it was just the seed of planned obsolescence that was planted in the 1920s back in Switzerland, and it took decades of bad decisions to make that seed spread across the broader economy. Fast forward to the 1970s, an economist named Milton Friedman published an essay that would quietly rewire the entire logic of American business. Its argument, distilled to its essence, asserted that a corporation's only real social responsibility is to increase profits for the shareholders, not the workers, not the communities, not the product quality itself, just the shareholders, full stop. And for a decade, that idea sat mostly in academic journals. Then in 1982, the SEC adopted Rule 10b-18, granting safe harbor for companies and clearer legal protections for large open market stock buybacks. That's a company buying its own stock from the open market, reducing the stock in circulation and pushing the earnings per share up as a result. And let's just say that makes the stock look really, really good. But before that rule change, repurchases like that carried a real exposure to market manipulation claims, which kept them rare and unusual. But after that rule change, buybacks went from a legal gray area to a routine low-risk tool. And in 1982, only about 2% of corporate profits went to buybacks. By the 2020s, it's estimated by some figures that above 70% in a given year of company profits goes back to buying its own shares. That's over $1 trillion a year, more than some entire industries are worth. Watch what happened to the numbers across the 1990s as the new operating logic took hold. Real GDP growth, which is the actual value of goods and services in a country, tended to slow down slightly from the prior decades. They started averaging closer to 3.2%. But the Buffett Indicator, stock market value against the actual size of the economy, crossed up over 100% for the first time in American history. And this is at the beginning of the dot-com bubble. CEO to worker pay, which had crept from a modest 20 to 1 in 1965 up to about 59 to 1 in 89, exploded to over 300 to 1 by the end of the 90s because CEO compensation itself had shifted from salary to stock options, meaning executives now personally profited directly and immediately from a rising share price that their own company buybacks were mechanistically helping push upward. Notice the shape of this. GDP growth slower than the 1950s and 60s, market value detaching from that GDP growth for the first time in the country's history. There isn't one single proven cause of why this happened. Falling interest rates, globalization, and the rise of tech and intangible asset-heavy companies all get a little bit of the credit from economists. But the timing lines up closely enough with the shift towards shareholder-first governance that it's really hard to call irrelevant. That's the moment the market started looking less like a mirror of the economy and more like something running on its own separate schedule. That brings us to our current day, as of recording this. Real GDP growth in the 2020s has averaged around 2.4%, genuinely one of the slowest of the three eras that we've gone over in this video. Slower than the 1950s, slower than the 1990s, and yet, as of 2026, the Buffett Indicator, remember that's the stock market value compared to the broader economy, sits at roughly 220 to 230% of the GDP, near an all-time high depending on exactly which data you use. Nearly double even the dot-com peak, and more than double the entire historical range of the market from the 1950s through the 1980s. Corporate profits tell the same story from another angle. After-tax corporate profits reached 12.4% of GDP in early 2026, the highest quarterly reading since 2021, and the second highest in data going back to 1947. Measured a slightly different way against total income earned by the country rather than GDP directly, profits hit their highest share since the early 1950s. CEO to worker pay, which was a humble 20 to 1 in the golden decades, now sits at a slightly less humble 281 to 1, or thereabouts. And stock buybacks, which were 2% of profits in 1982, now regularly consume the majority of corporate profits in a given year by some estimates. So here's the exact precise nature of the paradox that this video is trying to explain. The slowest growing real economy of the three economic boom eras is producing the most extreme, most detached, and most historically unprecedented market values of those three eras. Growth in the actual production of goods and services, that's slowing down. Growth in the value assigned to owning the companies providing those goods and services is accelerating like nothing ever before seen in American history. And many investors aren't asking why, which that kind of reminds me a bit of the old adage that it's hard for a person to understand something if they're paid not to understand it. Now let's go back to the first real question that I promised to answer at the beginning of the video. Why exactly does the market have to keep growing at all? Why can't it just stay in a nice place, the same size, Why can't we just keep the 50s GDP and economy and keep driving theaters and Cadillac Eldorados? The honest answer has three separate mechanisms that all kind of reinforce each other. First off, a stock's price isn't really a measurement of what the company's worth today. It's the present value investors assign to a company with expected future cash flow increases. If investors expect those cash flows to grow, they'll generally pay more for the stock than they would for an otherwise identical company whose cash flows never grow. That's just what growth is worth after it's been priced in. That doesn't mean that a flat, mature company is a bad investment necessarily. Utilities, insurers, and steady dividend payers prove otherwise every day. But it does mean that growth is the specific thing that gets rewarded with a premium, and a management team measured every quarter against that premium has a constant structural incentive to chase growth, even when steady and profitable, would genuinely serve the business and its workers and maybe its customers perfectly well, and perhaps even better in some cases. It could be argued that we're living through a time where most investors are only interested in dating company stock, not marrying it. Secondly, retirement itself has become far more market exposed than it ever was in decades past, in a way that adds serious pressure of its own. Go back to the 1950s and 60s. A much larger share of workers retired on a pension. That's probably what your grandparents might have had. A fixed, guaranteed promise of income from an employer insulated from the stock market's daily mood. But over the decades, since those pensions have increasingly given way to 401ks and IRAs and 403bs, retirement plans, that has shifted real investment risk onto individuals and tied a much larger share of the country's retirement security directly to whether or not the stock market is going up. Multiply that by the tens of millions of workers out there, and the market isn't just something companies want to grow anymore. It's a meaningful share of an entire generation's retirement. And that retirement depends on growth and creates enormous pressure to keep growing. It's not just Wall Street anymore. Thirdly, and this is part of Milton Friedman's essay, Set in Motion, it's actually a common misconception that U.S. corporate law legally requires companies to maximize shareholder value. It actually doesn't. Corporate directors generally have a wide legal discretion of what they can do, but law is one thing, and dominant practice and incentive structures are a completely different thing. And once maximize shareholder value became the philosophy taught in business schools and demanded by activist investors and directly baked into how executives get paid, staying the same size profitably and forever stopped being a philosophy anyone in a corner office had much incentive to choose. Not because it's impossible to run a business that way. Plenty of stable private companies do exactly that. But because a public company's leadership is now judged quarter over quarter against a culture that treats mere sufficiency as some kind of failure, put those three forces together and you get an economy where big enough isn't a crime. It's just overwhelmingly under-rewarded. Now the second question, and this is the one that cuts a little sharper. If the market has grown faster relative to GDP in the last 15 years than almost any other period in history, why do so many people feel like they're falling behind? The honest answer is that the market growing and ordinary people's lives improving used to be roughly the same statement. But in the past 4 decades, these became two separate ideas measuring two separate phenomena. Go back to the buyback number, 2% of profits in 1982, up to about 70% by some estimates recently. That's money returned to shareholders instead of being retained for company wages, materials, better R&D, debt reduction, or expansion. It doesn't prove necessarily that any specific dollar would have gone to a raise or a better part, but it does mean that less profit stayed inside the business or reached the people who work there. And that money went disproportionately to people that already own the stock. Ownership itself is concentrated. The wealthiest 10% of American households own the overwhelming majority of corporate stock. So when profits get funneled towards shareholders at record rates like we're seeing now, the growth is real, but it's just landing overwhelmingly in one place. And that place isn't the paycheck or product of the person who bought the item off the shelf. There's nothing morally wrong with this on paper. I love seeing people get great stock returns, it's part of my job. But it does bear discussion when we get down to how regular people's lived experiences are being handled. This also explains the craftsmanship paradox directly. A 1960s appliance company answered to a stable ownership base and a workforce that stuck around for decades. Durability was a selling point, and there weren't quarterly pressures to hit an earnings number by cutting some corner. A company today answers to shareholders who can sell their stake in seconds and to a compensation structure that pays executives in stock whose price needs to rise this quarter, not over the appliance's 20-year lifespan. And under that pressure, value engineering, using a cheaper part like an inferior steel gauge or a rubber gasket instead of a metal one, it's not a moral failure. It's the rational output of a system that rewards a quarter's numbers over the 10-year mark of a product's life. And almost every time these two incentives come head to head, they're in conflict. Our friends from Switzerland who conspired to make light bulbs worse, they had to do that in secret back in 1924. By the 1990s and 2000s, their secret plan had simply become how market incentives worked, out in the open, no conspiracy required. Layer on top of that a handful of other forces from these same decades, like a shift towards less aggressive antitrust enforcement back in the 1980s, heavy merger activity that contributed to greater concentration in certain industries, which reduced competitive pressure, globalization, offshore manufacturing, which caused a glut of cheap goods from overseas to come in, some of which were genuinely good. You know, and the picture's pretty clear. You also have a tax system that generally taxed long-term capital gains at a lower federal rate than ordinary waged income, and you get a fairly complete picture. There's not one single person or one single policy that caused things to turn out the way they did. It was just an architecture built decision by decision over decades that decided that the value of owning the idea of a company is more valuable than the products that the companies themselves put out. A handful of executives in a Geneva boardroom back in 1924 discovered something that took the rest of the economy another 60 years to fully realize. A thing that lasts forever is worth less to the person selling it than something you'd have to buy over and over again. And in 1924, that required a secret meeting in a Swiss laboratory to pull off in just one industry. By the 2020s, it required nothing but ordinary operating logic, public company, and a stock price that earns a premium for climbing. Nothing about this is written into law. It doesn't have to be. The incentives all point in one direction. And the market doesn't get bigger because bigger is better. It gets bigger because somewhere between the golden decades of the 50s and 60s and today, the entire system stopped rewarding a working definition of big enough. And every appliance, every car, every house has been built a little bit cheaper with a few more corners cut to work a little shorter. And that's all the physical evidence you need of exactly what happened. Thanks for watching. I'm going to start making some videos like this talking about various market topics, just whatever I can come up with. Hopefully you learn something. Hopefully it's kind of entertaining, and hopefully I'll get better on camera. Take care. Talk to you again soon.